Okay, so here's a summary of all the aspects of dealing with product costs versus period costs. Both examples are dealing with costs, but we're deciding whether that cost should be attributed to an asset or should we write it off as an expense. So to work out what's the difference between the two things, we have to work out, well, what's the same? And in the definition of both items, we're looking at getting items ready for sale. Ready for sale. If it's a product cost, the thing that it deals with is about that you can attribute to each item. But if it's a period cost, you can't attribute it to it. So that's the big difference between the two. Can you attribute it to each individual stock item? So we're going to look at these two trucks. In one truck, we've got 10 Ninja Stars. In the other truck, we've got 10 Ninja Stars, but some other different stock items. So because of that, we have to decide, can we treat them the same? Or if there was a cost involved with getting the trucks to the store, can we directly attribute them to each item? Now the one on the left is a lot easier because what I can do is say, okay, there is a cost associated with each item. So each one can get an attributed amount of the cost of getting it to the store. But in the other one, we've got different stock items. So it's not easy to do. So this side would be easy to see as a product cost. This side, we're more likely to treat it as a period cost. The effect of those things are different on the income statement, and that's what we're going to deal with next. Okay, so let's spend a little bit more detail looking at what a product cost is. It is a cost incurred to bring stock into a condition and location ready for sale, and it is allocated to stock items on a logical basis. Each item of stock can have individually calculated this product cost onto it. So anything that's worked out per annum, if you don't get the same quantity per month or per reporting period, you can't treat it as a product cost because that's not logical. You're unable to directly attribute it to it. So product costs, you need to be able to do it on a per item basis, and we are adding to the value of the stock item. All right, product costs, we've just seen on the slide before, it increases an asset value, and that asset is the stock item. So if the stock item is increasing, it's got to go into the stock card, and it goes into the in column first because it's an increase in the value, so it's going up, must be going in, and then the new cost price is added to the balance in the stock card, and there's a practical example to follow to show that. In terms of recording the transaction, obviously if you paid cash for it, it's going in the cash payments journal under the stock control heading, or the purchases journal if it was purchased on credit from one of our creditors. So here's an example of a stock card. We can see that on March the 6th, in this business, 10 items of stock went in at $100. So it gave us a balance of $100. We also have written a check 3 days later for some buying expenses associated with this stock item. So because we can directly attribute it to the stock item, we are treating it as a product cost. It goes into the in column in our stock card. So we have a new cost price value of our stock item. Each one has been attributed with the $5, so therefore our new cost price is $105. Cash payments journal, same thing, different checks. It's happened at different times, but it's increased the value of the stock, so it goes into the stock control column of the cash payments journal. In terms of the theory, you need to know the effect of treating it as a product cost on our accounting reports. Obviously, if this is done for cash, our operating outflows would increase, our cash will decrease. The income statement will only change if we sell the products. Because that product cost has been added to the stock value, it's only when it's sold does it show up in the income statement, because it's a part of the cost of sales. Because we know cost of sales is the value of the stock that has left our store. So the value of the stock in this example is $105 per item, including the original cost and the $5 extra expense. So the cost of goods sold will increase, cost of goods sold will increase, and our net profit will decrease. In terms of our balance sheet, the asset value will always be higher when we're using the product cost method. So you can see from the question, the example we've done here, it was originally $100, but because we've included the product cost, the value is $105. So the value of the asset is higher. Because of that, when you sell them, there is a greater decrease in the value of the asset, and the expense, that cost of sales, also decreases. So here's an example of those items that were in the stock card, but we're only selling 8 of them to give an example of when you don't sell them all. And in this first example, I'm keeping a constant markup because it actually makes a pretty big difference to the overall feel. Some businesses, like fruit, can have changes in prices regularly, so you can have that fixed markup of 100%. Other businesses have to stick with a price for a longer period of time, and that's going to have a greater effect in the difference between product and period cost, and I'll show that at the end of the video. Alright, so let's just deal with this sale first. Okay, so first of all, how did I get the cost of sales figure? Well, in this example, we worked out that the cost of the items is $105, and I've sold 8 of them. That's how I get the $840. It's 100% markup, so therefore the selling price of each of those items is $210. Times that by 8, that's where I get my $1680. Add 10% to get the GST. Debtors control is always sales plus GST. In terms of recording it in the stock card, 8 items are sold, 105 each. We're using FIFO, so the first ones in are the first ones out. 8 at 105 is 840. That leaves us with 2 at 105. So already you can see the product cost value, 2 at 105, is higher, asset value higher, than if we didn't use product cost, because it'd only be 2 at 100. So product cost value, asset value higher. So let's look what happens with the accounting reports. Now, first of all, when we're dealing with the income statement, in this example, you will see cost of sales is the only cost of goods sold. We don't have that period cost or that buying expense as a separate item. Why? Because we're attributing it to each stock item. So inbuilt in this number here is that $5 per item. The $40, $5 times 8 is $40 of that cost of sales figure comes from that buying expense. So our gross profit is $840. In my calculations for my balance sheet, you will see that I actually haven't included the payment of the buying expense. You could still do that, but here I've just shown the effect of the sale. Debtors control increase, stock goes down because I've sold it by the 105 times 8, gives us total assets left of 1,008. GST clearing increases because it's a sale, and the profit, which I've worked out up here, is an increase of 840, and I'm still in balance. Okay, now let's move on to the period cost method. Same as before, it's a cost incurred in getting stock into the condition and location ready for sale. That's exactly the same. The thing that is different is that it cannot be attributed to individual stock items logically, and instead of treating it as an asset, period costs are treated as an expense. So the whole amount is written off. The whole amount is written off as a lump sum in the period that it is incurred. So in terms of recording the information, the first thing to make sure you're clear on, it doesn't go in the stock card. It doesn't go in the stock card because we're dealing with an expense. It's not an asset. It's not increasing the value of the asset when we're using the period cost method. So it's got nothing to do with the stock card. The actual expense has to be recorded though, that buying expense. So if you paid cash for it, it goes in the cash payments journal. Can't go in the purchaser's journal for this one because the purchaser's journal is for the purchase of stock on credit. This is the purchase of an expense on credit. So our only other option is the general journal. So if we look at the way it's recorded in our subsidiary stock card to start us off, there is no entry in here. That first check for the 10 items at $100 is the only thing that's in the balance of this stock card. There's no extra in entry because there's no extra added value to the stock item. In the cash payments journal, it gets recorded because it's still a cash transaction. However, you'll notice in this case, it doesn't go in the stock control because it's not an increase to the value of the asset. It's an expense. So because I don't have a buying expense column, I would put it into the sundries column. In terms of the effect on the accounting report, same as before, if you paid cash for something, goes under operating outflows and decrease in cash. In terms of the income statement, it will always be in the income statement. It doesn't matter if I sell none or I sell 10 or I sell 3. If I have it as a period cost, then it is expensed when I've bought it and it goes under the cost of goods sold section. What that does is increases my cost of goods sold, decreases my gross profit, therefore decreases my net profit. In terms of the balance sheet, there's no effect on assets in terms of the value of stock. The stock value does not change. What does change is our owner's equity because we've got an expense, so therefore our profit decreases. So as I said before, for period costs, it doesn't matter if all items are sold. The expense is recorded and reported in the period the items associated buying costs were incurred and paid. So this is exactly the same example as before. I've sold 8 items. There's 100% markup. but you'll see that numbers actually change because of the method. First of all, the cost price of the item is only $100 when we use the period cost method, only $100. Still sell 8 of them, so my cost of sales figure is $800. That figure is lower. The cost of sales figure is lower than the product cost method. Because there's a fixed markup, double the figure, $200 is the selling price. That's how I get my sales plus GST. Remember, sales plus GST always gives us our debtors figure. In terms of the stock card, as I said before, there's only the one entry in there. So I had 10 at 100. I sold 8 at 100, leaves me with 2 at 100. Note that the closing value of the stock is less in this method. Under product cost, it was 2 at 105. Period cost, 2 at 100. The value of stock at end is lower using this method. Okay, so let's look at the income statement comparison. Because we are using the period cost method, the biggest difference that you will see is in the cost of goods sold. There is a lovely new line in there, the buying expense. We did not have that in the product cost method because we were doing it per item basis. So the cost of sales in this method is just the cost price times the quantity sold. And that's where the 8 times 100 comes from. But we have this period cost of $50. So have a look at this method. The cost of goods sold figure is higher using this method. It was $840 in the other method. It's $850 in this method. Why? Because we're writing the full amount of that buying expense off. Not just of the ones we've sold, the whole expense. Our gross profit, therefore, is also lower because our expenses were higher, profit goes lower. In terms of the effect on the balance sheet, I've actually put the whole buying expense in there so you can see the effect on profit because that $750 includes the buying expense in there. So that's why the bank decrease is there and it keeps it all in balance. So you can see our asset figure goes down by less using this method for the stock control, but our profit also goes down by less as well. So let's compare the two methods. This is when not all items are sold. So that's the first thing. Because if all items are sold, you'll see in the end, makes no difference. All that amount will get written off if you sell them all. But if you don't sell them all, it's different. So not all items are sold is the first thing we're looking at. And we've got that fixed markup. Okay, so first let's deal with selling price. As you saw from the example before, the selling price using the product cost method was $210. Period cost method, it was only $200. So you can end up with a higher selling price using the product cost method because of this fixed markup. In terms of stock control, we know that the value of stock went up by $5 per item. In period cost, there's no change to it, so it stays at $100. $105 for product costs. So in terms of cost of sales is higher per item using the product cost method because it would be 105 times the quantity, whereas in period cost it was only 100 times the quantity. So lower cost price per item, therefore it's going to be a lower cost of sales. this is where the change happens for period costs. There's no change in the cost of goods sold using the product cost method, but period cost, there's an increase in that buying expense. So cost of goods sold will be higher using this method. So therefore, the effect on profit, you will get a lower profit using the period cost method. In terms of the balance sheet, the ending value of stock control will be higher using product costs and lower using period costs, because remember, they're worth 105 in this method and they're only worth 100 in this method. So that's why it's got 210 value left, that's only got 200. Now let's look at the difference when we sell from the same selling price, because that's going to have a big effect. So we're still dealing with the fact that not all items are sold, but in this example, we're talking about a fixed selling price. So the entries will be a little bit different using this. So let's do it just with selling one item. And let's just assume that we have a fixed selling price of $300. All right, so selling price is going to be the same under both methods. The stock control, we know, gets the 5 extra. There's no extra for the period cost. So cost of sales, we know for one item's $105. Period cost, we know that it's $100. So in terms of increase to cost of goods sold, there's no increase here. But in period costs, the whole amount gets expensed. So it's an increase of 50. So even when one item's sold, you can already see there's a big difference between an increase in $5 by selling one item, and there's an increase of $50 when you sell one item. So there's a huge difference already in terms of the profit. So if you want to look at the difference in gross profit between the two methods, you'll see that you'll end up with $195 in this method, and you'll only end up with $150 in this method. So if you have a look at the two, the cost of goods sold in this method is $105. This method, it's $150. So you can see that there is a huge effect on profit by the choice of methods. In terms of ending value though, the ending value in the balance sheet, whatever we have left of the assets will be valued at 105 times the quantity. But in the period cost, it'll be 100. So the value of the assets will be lower for period costs and the profit will be lower. For product costs, profit's higher and the asset is higher. So if you're deciding on a method, it's all about making sure you have the most accurate profit. If you're likely to sell all the items, then it's fine to treat things as a period cost, because if you're going to use it all up, you might as well charge it all in one hit. But if that cost is more attributed to each item and the sales of those items happen over more than 1 or 2 accounting periods, you're better to make sure the profit and the cost associated with those assets are matched up a little bit better, and you'll get a better, more matching profit, because you'll know that it's more accurate. You've tried to link up as much as possible the sale of the asset and the cost of the asset in the same period as the sale. So last question, what is the effect of using product or period cost if all items are sold? And the simple answer is no difference. If we think back to that original example with 10 items, so we're selling them for $300 a pop. So $3,000 for sales, for both methods. In terms of cost of goods sold, you're going to have cost of sales will be 10 times 105. So 10 times 105 is 1050. There's no other buying expenses under product cost, so that's it. In the period cost method, we've got a cost of goods sold that'll have cost of sales of 10 times 100, which is 1,000, plus the buying expense of 50,1050. So you can see from there that under both methods, you'll get the same amount of profit, which is 1950. So that just proves the point. If you use product or period costs and all the items are sold, all of them are sold, there is no difference between the two. If you've got a selling price that is the same, it's fixed for both. All right, I hope that explains the difference between the two and made it a bit clearer.